China's closely following is not voluntary. The evolution of history has never been dominated by a single force, but rather the result of multiple factors intertwined and combined, as in the frenzy in the Chinese stock market that lasted for over a year between and is generally believed to be driven by multiple factors such as China's economy entering a take-off period, unexpected growth in corporate investment returns, successful stock reform, a surge in foreign exchange reserves caused by foreign trade surplus, and the influx of hot money and liquidity flooding used by the appreciation of the RMB. These reasons do indeed exist, but Foucault believes that these are only superficial and visible reasons. And in addition, they are also the fate of financial civilization. Originally the replacement of one new civilization with another old civilization meant a change in the original way of life and values. The countries or regions that first entered the new civilization will undoubtedly become the setters of new game rules and leaders of life changes due to the disruption of existing game rules. For example, the UK, which first entered the industrial civilization, and the United States, which first led the new economic civilization, not only won the highest end of the main industrial chains manufacturing it of various civilizations, but also made most developing countries follow their management concept and development models. However, being able to enter a new civilization is indeed a fate and a natural result of various conditions. Now, under the condition of having the most, the United States and the United States have taken the lead in monopolizing the financial civilization. On the other hand, China clearly does not have the mature conditions to control financial civilization, but the objective existence of Chinese characteristics in the following aspects may be driving China unconsciously to follow closely into the door of financial civilization. Firstly, why China has objectively become the most open system. According to statistics from the Ministry of Commerce, as of China, a total of foreign invested enterprises have been approved for establishment, with an actual amount of foreign investment of billion US dollars. In terms of rate, the proportion of foreign investment stock to China's GDP in was % higher than the global average of %. However, China's opening up to foreign capital is receiving risk education due to the structural transformation of foreign capital itself. Foreign capital is increasingly entering in the form of financial capital, leveraging China's vast resources in an asymmetric way of currency symbol that come and go freely. And for Liang shift 1,000 in foreign investment continuously acquired the equity of Chinese steel, banking, cement, beer and other enterprises with large sums of money. In just 4 months, 5 foreign institutions directly or indirectly invested in domestic cement-listed companies. However, to some extent, the influx of foreign financial capital, foreign financial institutions will also play a role of catfish effect, accelerating the process of China's financial reform, stimulating Chinese people's original investment awareness, indifference and numbness of the financial concept. Secondly, the currency position difference is too large. The price of a country's currency, also known as the exchange rate, is actually all domestic goods compared to US dollar assets. RMB assets undoubtedly have huge room for appreciation and speculation due to their total bid price. The essence of financial transactions is speculation, and places with stories will naturally attract international financial speculators. The consistent expectation or premeditation of RMB appreciation has caused excess global liquidity to accumulate in China on the one hand, settling on physical assets and resources such as real estate and stock market, triggering various RMB asset protection in China war. On the other hand, the excess funds are driving the innovation and development of financial derivatives such as stock index futures, options, commodity futures, etc., causing China's virtual economy and real economy to grow dually separate, because only through the development of financial derivatives can the connection with the domestic real economy be blocked, creating a space for international speculators to freely speculate and allowing excess currency to evaporate as much as possible, such as the rapidly developing derivatives market in the City of London after the financial bomb. May it avoid domestic real resources being hijacked by international financial capital. The anti-Japanese war itself and the development of the virtual economy mean that China is being pushed into the era of financial civilization by international speculators. Thirdly, the complexity of China's financial sector is very high. This complexity is mainly reflected in different types of A shares, B shares, H shares, etc. Parallel coexistence of stocks and their corresponding rules. Staggered operation of various investment mechanisms such as QFII and QDII. It may even form a coexistence pattern of multiple financial centers such as Hong Kong and Shanghai. However, on the one hand, simpler things are less prone to errors, and more complex things are more likely to have vulnerabilities, which are easily exploited. At present, there is still a long way to go before the game rules in all aspects of China's financial sector are in place. The improvement of the game rules in the stock market itself and the establishment of rules in other financial markets, including futures, options, and other derivative markets, can provide speculation opportunities for funds. Since the beginning of FIS, inconsistent words and actions constantly applying to increase investment quotas while loudly short-selling the stock market have been exploiting the policy uncertainty, instability, and unpredictability of the Chinese stock market to profit. On the other hand, the more complex a system is, the more stable it may be. On May, China's A-share market unexpectedly fell % due to an increase in stamp duty. On the same day, the H-share market only fell % while the B-share market fell more than %. This phenomenon has been referred to by foreign media as the strange phenomenon of Chinese corporate stock prices. For foreign investors, the chaos of China's finance is evident. In addition, China's finance is opening up to the outside world, and in the face of various disturbances from external forces, Hong Kong can play a buffering role to some extent. It can be foreseen that China's finance will be forced to develop greatly in the process of being utilized, and the stability of complex system self-organization. However, the complexity and chaos of the financial field itself not only confuse foreign financial capital, but also the management of China. It can only be a matter of cracking down on the situation and being dragged away by the situation. Fourthly, the Chinese-style social liquidation is the most peaceful. It is common around the world that too much funds need to be liquidated. The law is only expressed differently in different economies. In the classic market economy, the outbreak of financial crises became the main way to evaporate funds and close positions. But it brought about severe economic fluctuations and social unrest. For example, the Asian financial crisis caused many large companies to go bankrupt. In South Korea, people also used their household gold products to help the government overcome difficulties. Under China's special way of settling funds, the administrative liquidation has replaced the severe financial crisis. The management often directly forces project shutdowns in the form of policy directives, causing the chain of huge funds to instantly achieving the effect of cooling and evaporating. During this process, banks with government guarantees played the role of shock absorbers. For example, the T-Bun incident completely wiped out the billion-yuan loans of 6 financial institutions, forcing banks to follow the company and suffer significant losses. From this perspective, the market economy with Chinese characteristics has alienated the classic expression of financial crisis and to some extent ensured the smooth operation of the economy. But this seems to It also weakens the vigilance of relevant parties towards the international financial strategy hidden behind the financial crisis, which began with Soros selling short the Thai currency. From this perspective, it is the openness and complexity of the system, as well as the enormous imagination space of currency value, that objectively determines finance the arrival of civilization's fate. At the same time, the stability brought about by complexity and the calm waves brought by Chinese-style closing positions make Chinese people who are accustomed to gradual and passive correction subjectively unclear and unprepared for this new fate. However, in the middle of the management's balance of the asymmetry that arises in reality, in the spontaneous real practice of the private sector in addition to the stock market, there are also the emergence of private finance such as Guanqi and Zeshang Fund, which has accelerated the process of financial opening up, gradually separated the real economy from the virtual economy, and formed financial awareness and rules. It can be seen that China is unconsciously entering the door of financial civilization, and the muddled state dragged by reality is expected to continue for a long time. Due to a lack of understanding and reflection on the new civilization, the original regulatory methods have still been followed. However, as regulation has been repeatedly falsified, Traditional theories and empirical methods have been overturned one by one, and all sectors of society will gradually recognize the situation and understand financial civilization